Hi guys, this is Dr. Shamim Nazir. Thank you for joining us. Today we have Susan Bryant, CPA and CTS of Unboxed Advisors. She's going to tell us a little bit about what we should be looking for when we are talking about tax planning, what's important and why. And also we're going to get into the new tax law changes and how that might impact us. So welcome to the podcast, Susan.
Oh, well, thank you so much for having me. I'm so excited to be here.
Of course. So tell us a little bit, first of all, you are a CPA and a CTS. What does that mean?
Yeah, so most people are familiar with CPA, Certified Public Accountant, which is a designation that I received many, many years ago now. But I was recently bestowed the honor of becoming a Certified Tax Strategist, CTS, one of 50 in the entire United States, and it's been a journey. I went from a certified tax coach to a certified tax planner and now to a certified tax strategist. And that really just basically means that I have been educated and I have a proven history and track record for helping my clients to really leverage the tax law to their greatest benefit to save them both taxes and help them reach their financial goals.
Okay, very good. So that's something I never think about, tax planning, as I was telling you earlier. First of all, a lot of doctors, actually, you wouldn't believe 80% of physicians are W-2 employees. So we don't really think there is a lot of planning for us to do, but we could be wrong. So tell me a little bit about what is tax planning and what should someone who maybe has a W-2 or a 1099 job, what can they do to really optimize their tax situation?
Well, the first thing that's really important to understand, and this is generally speaking, is a lot of times people don't even really understand the compensation structure they've entered into. I've seen in many instances where physicians receive a W-2, but then they're also getting some type of K-1 from the hospital system or something like that. And so sort of understanding the types of income that are coming your way. W-2 income is ordinary income, you're active, and there's no way to reduce W-2 income. And the tax law is pretty clear on that. Outside of 401k, which is a pre-tax deduction, medical insurance premiums, there's really not a lot of other ways where you can mitigate W-2 income. But when you move to things like K-1 income, 1099 income, then all of a sudden there become more ways and alternatives under the tax code to offset that income by entering into either additional investments, like a lot of times the income that physicians are receiving from the hospital systems, it's passive income. And so they need passive losses to offset that income and insert probably some of your audience members who are looking to invest in real estate. So that any passive losses they might receive there would offset that passive income. And then certainly for 1099, contractors or anyone who has an actual business entity where they have a practice that they're running, really that's when you get into more business type expenses and deductions that can be optimized in order to drive down taxable income while at the same time accelerating savings in other areas.
And when you do tax planning, what does that entail?
Oh, that's such a great question. Okay, so this is probably where most people get like totally confused. They're like, I prepare my return every April, so I'm tax planning. No, no, no. Tax planning is way different than preparation. Preparation is literally after the tax year closes, taking all the information, putting it into the tax forms, and then filing that with the IRS. Planning is a whole other animal. It's really the idea that we're going to collect information about what's happening now and extrapolate what we think that's going to look like for the remainder of the tax year and begin making decisions, planning decisions based upon what we know is coming and altering what would be the final projection of that taxable income based on the decisions that we've made. So planning becomes it's a lot more fun. I'll just put it that way. Okay. Preparation is really not that exciting, especially for the taxpayers, right? People are like, okay, great. I usually am going to get a bill. That's not very exciting to me. But planning is your chance to change it by really infusing both your goals into it, perhaps some of the risk tolerance you might be willing to take, opening yourself to potential other opportunities, investment opportunities. So you get to change the outcome. So that's what planning is really all about, and understanding that in advance before you make the decisions and understanding the implications of what those particular decisions are on your taxes. I mean, it's going to impact a lot of other parts of your life too, but you also want to know, is it going to save me money? I mean, I'm sure you've probably seen this in a lot of cases where I've had clients in the past who've come to me and they're like, Susan, I just bought a rental house and it's going to save me all sorts of money in taxes. And I'm like, well, you're not active in real estate. You make over 100K, and so I'm really so sorry, but that residential rental property is not going to do anything for your taxes, and they're very sad. That's when I remind them that, this is why you have to come and have a planning conversation before doing anything big, so that you really do understand, hey, what is it going to take for me to have some type of reap the rewards from a tax perspective on this particular type of investment? I mean, you probably argue that like, it's so awesome for someone else to pay for a rental house, and I would totally agree. But a lot of times people are chasing sort of a twofer. Somebody buys me an asset and I get a tax benefit.
Yeah, I hear this a lot. And I guess it's that whole, real estate professional status, which is very difficult to meet if you're an active employee or a professional. You're not going to really
Oh,
meet that criteria.
yeah, it's really challenging. I mean, that's a lot of hours to get in a year, 750 hours. I mean, it's a ton. I mean, if you're working a
Well,
full-time job,
actually, in case some of our listeners don't know what that is, maybe you could tell us. So when you are investing in real estate, it's considered passive income, and the only way to really you can only offset the passive losses against the passive income, and not your W-2 or 1099 income. It doesn't impact the tax liability there at all, unless you are a real estate professional. And so tell us a little bit about that real quick, just so people know what we're talking about.
yeah, so there is, obviously the IRS is kind of keen to some of these potential ways that people might take advantage of the tax law. And of course, notoriously, real estate does generate losses, mainly because it's financed. So there's interest, and then there's depreciation. And there's a lot of ways that depreciation can be accelerated. So usually these are maybe cash flow break even, maybe a tiny bit cash flow positive, but really the performance of the entity becomes a loss from a tax perspective because of that non-cash depreciation deduction. When those losses start to pile up, people would love to offset that against all of their other income. But the IRS basically, this is many years ago, they, became aware of these trends for people to invest in real estate and take advantage of these losses. And they said, look, if you are not active as a professional real estate individual and you do not have that designation, which is 750 hours of service, and typically you also are looking to have like a real estate license, you are actively engaged, and you have a material financial interest, like you're materially participating in the investment properties, only then can you achieve that status, which then unlocks these losses to then offset that other income. Yeah,
So yeah,
it's
Susan, I've heard the same thing. To get the qualification as a real estate professional, you said 750 hours in that
yep,
real estate operating of the real estate over the year. And I think you also need to spend a majority of your hours. Is that
yep.
correct? Or more than half
That
or something like that?
That's right, exactly, and materially participating in the financial aspects of the business too. So, I mean, you got to be actively engaged in it. I mean,
Mm.
that's kind of the idea here, anyway. Is that if you are a real estate professional, this is kind of your full time job. It's or close to it, at least almost part time. I mean, we figure 2,080 hours is full time job. It's a little less than a part time job. That's still a lot of hours to be achieving.
Yeah.
So, you got to be actively engaged in managing those properties. So and they can be sticklers. The IRS can certainly become a stickler when it comes to that because they understand the power of those losses and how they can reduce income.
So when you talk about tax planning, I want to hear a good example of that. Like, because I've been mostly W-2 and then some 1099. And then now I'm kind of a business owner, but it's still in its infancy, so not really much. So what is somebody else, not myself, but somebody that actually needs tax planning? What would you suggest to them, or what kind of mechanisms do you
Uh,
have?
Yeah, so I would say this. So if you have an entity that has substantial operations where you need to keep a set of accounting records and you need to understand the performance of that business, and you find that your tax liability starts creeping up, where, you become more and more shocked, I think would be the right word. Like, there's no way I can owe that much. Like, and those bills become more and more of a surprise to you. So every April, your CPA or your tax preparer is reaching out and they're like, oh, you owe $100,000. Like, and you are on the floor and having a hard time picking yourself up. That's generally when you become a very good candidate for tax planning. Because what that tells me is that if you are not keenly aware as to what taxes are due and when, then you're not planning. You're just reacting. So I'll give you an example of sort of like the process that I normally go through with our clients. Mid-year, well, we'll prepare the returns in March and April. We'll try to get those in the rear view as quickly as possible, because once the tax year closes, preparation is just put the numbers in the form, like I mentioned before, and you got to just move on with your life. I mean, there are some things you can do post year end, but they're very few. So we do what we can. We try to mitigate what we can, but then we just cut our losses and we got to shift to the current year. So then it's a matter of keeping the accounting records updated, making sure we've got solid, disciplined processes for accurate information coming from all sources. Okay, so some of that is W-2, some of it's real estate, some of it's operational businesses like a practice, it could be other investments. All that information is getting collated. About mid-year, we're doing a calculation and saying, if the second half of the year looks like the first half of the year, what does that mean in terms of what we expect our total tax liability to be? And I would argue, even to some degree, W-2 employees probably would benefit from a look-see at that, to see if their withholding is adequate. Are there other things that they should be thinking about or could be thinking about? Maximizing their 401k, participating in a variety of other plans of the benefits, that the HSA contributions, those kind of things. At that point, then we are kind of introducing the idea of what are some things and options that we could do mid-year that we might want to pull the trigger on in November and December. But we're going to educate from essentially mid-June through about mid-November. Do we want to introduce a 401k plan to a business if they don't have one, or a defined benefit plan? Is there opportunity to leverage a different type of entity, whether that's S Corp or C Corp? There starts to unlock sort of these things. Are they interested in real estate? Is that something we want to pursue? Getting them connected with people like you. So we really kind of open those doors up. Over that period of time, once we've educated, when we get to November, we've got a much clearer picture of what the year end actually is going to look like. 30 days out, most people know what their business is going to do, what their investments are going to do. They're pretty keen on a general idea. And so we have a much clearer picture, and we can finally pull the trigger on, like, okay, we're definitely going to do the defined benefit plan. Okay, we're definitely going to set up a C Corp and move some money over there, and use that as a way of purchasing permanent life insurance. We'll kind of go through and tick all those things out, and then come up with the for sure projected income tax liability. And then we are specifying how much is due by January 15th. And my clients know by, mid-December exactly what they're going to owe on April 15th. Coming up, it's March 19th right now. We're recording this. So in about 2 weeks, I'll send a reminder email to all of my clients and say, reminder, this is what we talked about back in December, and you're going to owe this amount on April 15th.
Okay.
That's sort of like how the process should work. I'm always saddened when I realize that most accountants don't offer that service to their clients. It's not even that it's not offered, it's just not available. Certainly, the more money you make, the more important it is to start having those planning conversations.
Yeah, absolutely. Now, tell us a little bit about the tax law changes. What's happened?
Oh, man. It is an exciting time in our, I see this a lot. Like, we live in like the best timeline ever. Okay. So definitely some exciting things happening. So back during Trump's first presidency, there was introduction 2018 of the Tax Cuts and Jobs Act. Okay. That set of laws is set to expire at the end of 2025. Just order of operation, it goes away unless Congress acts. There's been a lot of pressure. I mean, I was just listening to Secretary Bessent say that, they want to make those tax cuts permanent, which means not just going through the reconciliation function, but actual congressional law that would have to get passed both in the House and the Senate. that would make those permanent. And that's things like the 20% qualified business income deduction. Remember personal exemptions, and how we had to keep track of those before? That went away, and we got this much larger standard deduction. So all of those things, the tax rates are supposed to go back up. I mean, there's some going from at the top marginal tax rate all the way back up to 39.6%. I mean, it's high. I think everyone who owns a business, I mean, really everybody wants to keep more of their money in their pocket. That's on the docket. Trump has also made it a priority, and not that this probably applies to a ton of your audience members. However, no tax on tips, no tax on overtime. That might impact some of their office staff, and no tax on Social Security. The expectation is the goal, I believe, for the Trump administration and Secretary Bessent is to have this law passed in the May timeframe. So by Memorial Day, that's what they're shooting for. But we're going to have to wait and see. There's just going to be a lot of we have to be ready either way, which way it goes. If the laws expire or if they get renewed in the current form or in some alternate form. But it is going to be just imperative this year to be at the ready for what are we going to see coming down the pike. So you got to keep your ears open on the tax stuff. And I'm kind of wondering if they're going to start making some adjustments. So your audience members, as physicians, anybody working in the healthcare field, if you make over a certain dollar amount and you own a practice, you get phased out of the qualified business income deduction, which is that 20% deduction on your K1 income. I'm just hopeful that for all of the physicians, attorneys, accountants, financial advisors, and consultants, that maybe they'll have some mercy upon the business owners who are taking risk in those fields of practice and actually make that deduction available to them, because it's quite sad that particular deduction, they've been, physicians and healthcare practitioners have been denied that deduction for so many years. And that's just, I'm hopeful that that's going to be changed. And I think another one of the areas where I know as people who are homeowners really want to see changed is a limitation, that cap on the state and local taxes on the itemized deductions. If they have a significant amount of property taxes, still paying mortgage interest and making pretty significant charitable contributions, they really get hammered on the 10K deduction on property taxes and, state and local sales tax. And if there's any out of state filers, certainly any state income taxes too. It's been a real burden on a lot of taxpayers. So just got to keep your eyes and ears open. Probably in the May timeframe, put a reminder in your calendar. Memorial Day might be memorialize your potential tax savings. It's supposed to be a really interesting year. You guys, I'm sure not everyone is going to be following it as closely as I am, but certainly just connect with me on LinkedIn or something. I'm going to be trying to keep everybody posted on the things that are happening in the tax world.
Yeah, maybe we'll have you back in May so you can update us on what to expect or what to do from there when we
Yeah,
get
right.
the
I
final
mean,
verdict.
hey, fingers crossed that we see, bonus depreciation. How many business owners have been buying equipment and right now, it's limited and on its way down to zero. So,
Yeah.
we are all really excited about what is possible in terms of how tax savings can fuel business owner growth. Man, it would I saw what it did the last go round, when this first got enacted. So I'd really love to see that for the business owners and especially for physicians, because we know you take a lot of risk operating businesses, a lot of risk.
And I know the real estate investors love that too. So
Oh yeah, heck
that's
yeah. The
awesome.
5-7 year property for you to do a cost seg and then
Yeah.
accelerate that. Of course, that's a fantastic, especially if you've got other active income or other real estate income to offset, right? If you've had some
Mhm.
properties that where the depreciation is almost nothing, man, you really need to keep feeding the beast. Buy a property, do a cost seg, drive the income down on the other, offsetting the other rental income from the other properties. So yeah, I've got a client right now who's got 25 plus rental properties, and that's pretty much what the strategy is. Every year we're looking to buy a property or a multiple properties, do a cost seg, and really the amount of savings we can get through that accelerated depreciation determines what properties we're buying. right?
Well, very exciting. I'm very curious to see how this plays out. So we'll have to definitely have you back and educate us on what to do with the new laws and how we can take advantage of those. But so thank you so much, Susan. This has been fun. I hope we can continue to learn from you. And how should we get a hold of you if somebody wants to learn more or engage with you?
Yeah, so come follow me on LinkedIn, Susan Bryant, CPA, CTS. You can find me there. Or you can shoot me an email at susan@unboxedadvisors.com. Always happy to hear from folks and answer any questions.
Awesome. Thank you so much, Susan.
Yeah, thanks
And
for
thank
having
you,
me.
everyone, for joining us on the podcast. And we'll see you next time.